Want to own a slice of a business that basically can't lose? Like the idea of sleeping well at night while collecting safe, growing, passive dividend income? Looking for a rare deal on a high quality stock that almost never goes on sale? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is selling basic products like cleaning supplies and trash bags to millions of consumers. Consumer staples businesses are awesome to invest in. They're easy to understand, their trusted brands are everywhere, and their products are oftentimes necessary for everyday life. That necessity means growing profits year in and year out, and that translates to growing dividends year in and year out. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Clorox Co., which appear to be trading at a significant discount today. Clorox Co., stock ticker CLX, is a global manufacturer and marketer of a variety of everyday consumer products. Founded in 1913, Clorox is now a $22 billion by market cap consumer staples giant that employs more than 8,000 people. The company has four sales segments: health and wellness, 41% of fiscal year 2020 sales, household, 27%, lifestyle, 17%, and international, 15%. Some of their major brands include Brita, Burt's Bees, Clorox, Glad, and Kingsford. The global pandemic will come to an end in the near future. However, there's an argument to be made that consumers will remain more cognizant about personal hygiene habits for many years. While the company's large bump in sales over the last year was largely temporary, certain habits and brand awareness don't just disappear overnight. And as a global leader in the cleaning space with trusted brands, Clorox stands to gain permanent market share and mind share as a result of the pandemic. As such, the company could end up becoming a pandemic winner. Even without this benefit, though, Clorox has already reliably increased its profit and dividend for decades. But I think there's a very good chance that Clorox ends up stronger from all of this, which bodes well for their ability to grow their profit and dividend at an even higher rate in the future. As it stands, Clorox has increased its dividend for 43 consecutive years. The 10-year dividend growth rate is 7.5%. This inflation-beating dividend growth rate is very nice, especially when paired with the stock's market-beating yield of 2.6%. This yield, by the way, is 20 basis points higher than the stock's own 5-year average yield. The payout ratio is a very manageable 64.4%. I like dividend growth stocks in what I refer to as the sweet spot. That's a yield of between 2.5% and 3.5%, paired with a high single-digit or better dividend growth rate. Clorox is squarely in that sweet spot. Looking at business growth, Clorox grew its revenue from $5.231 billion in fiscal year 2011 to $6.721 billion in fiscal year 2020. That's a compound annual growth rate of 2.82%. What Clorox might lack in huge sales growth, I think they make up for in consistency. The top line growth has been incredibly consistent over the last decade, just steadily moving up from year to year. It's been almost secular in nature. Meanwhile, earnings per share increased from $4.02 to $7.36 over this period, which is a compound annual growth rate of 6.95%. Again, this growth has been very consistent. Clorox won't knock you dead with growth, but it's steadily improving year after year. We can also see where the dividend growth came from. It matches up almost exactly with earnings per share growth over the last 10 years. Clorox has expanded its margins considerably, which explains the excess bottom line growth. And this margin expansion wasn't a one-time pandemic benefit either. There's evidence of steady expansion over the last decade. Looking forward, CFRA is anticipating that Clorox will compound its earnings per share at an annual rate of 10% over the next 3 years. This would be a lot of bottom line growth acceleration. In relation to earlier points I made on permanent tailwinds for the business, CFRA states, and I quote, "Certain consumer habits, e.g. health, hygiene, personal care, are likely to be forever changed due to COVID-19, unquote. Now, this could be a rising tide that lifts all boats in this industry, but I happen to believe that Clorox's brands stand out. CFRA seems to agree with one of their notes stating, and I quote, "Compared to peers, we think Clorox will have a longer sales tailwind from the pandemic," unquote. Even if Clorox doesn't have a permanent tailwind in place, we're looking at a market-beating yield and a high single-digit long-term dividend growth rate. If that's a base case, color me pleased. However, there's room for optimism here. With that, the odds are good for bigger dividend raises and or a shrinking payout ratio when we look ahead. Moving over to the balance sheet, the company has a rock-solid financial position. Long-term debt-to-equity ratio is 3.06. This is high because of low common equity, not because of debt. With the interest coverage ratio near 13, Clorox has no issues with debt whatsoever. Profitability is robust and it's been improving of late. Over the last 5 years, the firm has averaged annual net margin of 12.97% and annual return on equity of 161.67%. Low common equity inflated the return on equity. Nonetheless, the numbers are very good. I see a lot to like about Clorox. It's a business that's been around for more than a century. It sells basic consumer products that everyone knows and uses, owns trusted brands, and it could benefit from sustained changes in consumer behavior. Of course, there are risks to consider. Litigation, regulation, and competition are omnipresent risks in every industry. The competition isn't blind to the change in behavior and increased demand for hygiene products, which translates to even more competition. Rising input and labor costs will likely weigh on near-term results. The company's international exposure is somewhat low relative to major competitors in the consumer space. This concentrates Clorox domestically. Clorox has some customer concentration as well, with major retailers accounting for significant portions of annual sales. Despite brand value, there are no switching costs with consumer products. Even with these risks, Clorox still strikes me as a very appealing long-term investment idea. With the stock down 10% year to date and back to where it was when the pandemic began, the valuation makes the stock that much more appealing. The stock is trading hands for a price-to-earnings ratio of 25.1. That's lower than the broader market and is basically right in line with the stock's own 5-year average. Indeed, the valuation in general doesn't seem to price in any kind of long-term tailwind from behavioral change. The stock has dramatically fallen from pandemic-induced mania that drove the stock up to well over $200 a share. It's now back to where it was in March 2020, which counts the sales over the last 15 months for basically nothing. The price to cash flow ratio of 14.1 is lower than its own 5-year average of 19.5, and the yield, as noted earlier, is slightly higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in a 10% discount rate and a long-term dividend growth rate of 7.5%. This dividend growth rate assumes the status quo. It's right in line with the 10-year demonstrated dividend growth rate, which itself is not far off from the demonstrated 10-year earnings per share compound annual growth rate. So I'm not modeling in any market share or mind share gains at all, which I think is really erring on the side of caution here. In my view, Clorox could stand to do quite a bit better than this, but with so much near-term uncertainty, I'm relying more on Clorox's long-term consistent track record. The dividend discount model analysis gives me a fair value of $199.52. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Clorox as a 3-star stock with a fair value estimate of $171. CFRA rates Clorox as a 4-star buy with a 12-month target price of $210. I came out somewhere in the middle here. Averaging the 3 numbers out gives us a final valuation of $193.51, which would indicate the stock is possibly 8% undervalued. Here's the bottom line, guys. Clorox Co. is a high-quality company with great brands and incredible consistency, and they're positioned to actually benefit from all that's occurred over the last year or so. With a market-beating 2.6% yield, high single-digit dividend growth, more than 40 consecutive years of dividend raises, and the potential that shares are 8% undervalued, this looks like a rare deal in the consumer staple sector for dividend growth investors. And now for a special news announcement. Lockheed Martin Corporation, stock ticker LMT, just bagged another huge contract. This time, it's a $5.5 billion defense order with Switzerland for F-35 Lightning II fighter jets. All Lockheed Martin seems to do is bag new contracts, add to the backlog, and basically print money. We highlighted this stock's appeal back in May, so make sure not to forget about this name. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This six-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.